Ladies and gentlemen, good day and welcome to the Lumax Industries Limited Q4 and FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need operator assistance during the conference call, please press star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Deepak Jain, Chairman and Managing Director of Lumax Industries Limited. Thank you, and over to you, sir.
Good afternoon, everyone. I hope everyone is continuing to do good health. Along with me on this call, I have Mr. Anmol Jain, the Joint Managing Director, as well as Mr. Vineet Sahni, CEO and Senior Executive Director, along with other members of the Lumax management team. The results and investor presentations are uploaded on the stock exchange and company's website, and I hope everybody has had an opportunity to go through the same. To begin with, the challenges for the automotive industry continued due to the shortage of semiconductors, geopolitical tension, and supply chain disruptions on account of the third wave of COVID-19. However, we have outperformed the industry growth and were able to stand our ground during these challenging times. We have been able to manage a supply chain efficiently with our vendor network to overcome these short supply challenges and are hopeful that the scenario of short supply will ease off during the current and the next quarters. Despite all the challenges, the auto industry posted growth even during these turbulent times, and the economy has bounced back and are operating at pre-pandemic levels and showing signs of recovery and growth for the coming financial year. In the PVs, the demand momentum seems to be sustained, led by easing supply chain constraints, new launches, growing preference for personal mobility, and improved consumer sentiment. Further, the recent reductions of fuel prices announced by the government would also benefit the auto industry. The reduction in fuel prices would particularly benefit the two-wheeler segment, where customers have been impacted adversely by persistent inflation in the total cost of ownership over the last 2 years. We anticipate the auto sector to benefit both on the demand as well as on the cost side. Besides the curb in fuel prices, we also believe that the government's export duty hike on steel and plastic bodes well for the auto sector due to the elevated commodity inflation. The measures announced particularly should help in offsetting steel price increases and help the auto industry to cope up with the inflationary cost pressures. We at Lumax Industries continue to be the market leaders and preferred suppliers of the OEMs in India for automotive lighting solutions in two-wheeler, fast car, farm equipment, and commercial vehicle segment. Our technical and financial collaboration with Stanley Electric Japan makes us efficient in localizing this global technology for lighting. We are expecting new technologies such as AFL, ADB projector systems to play an important role in mobility in India towards safety, and we are working with our customers to develop these products. We are still holding to a long-term target of achieving 50% from the LED segment and battery from the conventional lighting. For FY22, LED segment contributed 33% of the total revenue, which is similar as last year. During the quarter, the company has commenced the commercial production of automotive electronic components at its new manufacturing plant situated at Balwad, Haryana on 12th of January 2022, and the company has also started commercial production at its new Sanand plant situated at Gujarat on 29th March 2022. During the quarter 4 financial 22, the following models have been launched which have our lighting. In the passenger car segment, we have MG Motors Astra and Toyota's Fortuner, and in the two-wheeler, we have Hero's Destiny 125, Hunter 150, and HMSI's CB300R. The company was also awarded at the Pantnagar, Gurgaon, and Chakan plants for the Gold Award in Excellence in Manufacturing, Silver Award in Excellence in New Product Development, and in Excellence in Human Resources, respectively, in the Atmanirbhar Excellence Award category held by ACMA. We further believe that is at the cusp of revival with various new launches by the OEM ability of EV, especially the two-wheeler and three-wheeler, and favorable policies by the government should elevate the demand in the near future. At Lumax, we also committed to increase offerings with new products, as well as increasing the wallet share in our existing OEMs, in addition to our product portfolio and new launches. We have a focused approach in R&D, and we continue to strive to provide more efficient and improved products for the market, not only in the field of lighting, but also in the electronic localization. The company holds a strong order book of 800 crores, and we are looking forward to an improved and sustained performance in the coming fiscal. Now, I would like to hand over the line to Mr. Sanjay Mehta, our Group CFO, to update you on the financial performance of the company.
Good afternoon, everyone. Let me brief you on the operational and financial performance for the quarter 4 and FY22. With respect to product mix for FY22 as a percentage of total revenue, 64% revenue is from the front lighting, 25% from rear lighting, and 11% from others. With respect to segment mix for the FY22, as a percentage of revenue, 65% from passenger vehicle, 28% from two-wheelers, and 7% from commercial vehicles. With respect to financial performance at consolidated level, the revenue stood at rupees 549 crore for the Q4 FY22 as against 504 crores in Q4 FY21, up by 9%. On full year basis, the revenue stood at rupees 1751 crores for 12 months this year as against 1426 crores for 12 months last year, up by 23%. Excluding molding sales, the revenue for Q4 is 488 crores as compared to 491 crores in Q4 last year, down by only 1% as against industry growth of 16%. On full year basis, the manufacturing revenue stood at rupees 1,659 crores as compared to 1,375 crores in 12 months FY21, up by 21%. The company reported consolidated EBITDA of 61 crores at 11.1% in Q4 FY22 as against 65 crores at 13% in Q4 FY21. There was a subsidy income amounting to rupees 13 crores in Q4 of last year. Excluding the same, EBITDA margin for Q4 FY21 would be 10.4%. The margins have improved by 17 bps in Q4 FY22 versus Q4 FY21 if I exclude the subsidy income of the last year. The EBITDA margin for 12 months FY22 stands at 8.5%. The company has incurred an exceptional expense of rupees 6.79 crores in Q4 FY22 and rupees 17.14 in FY22 12 months towards voluntary separation scheme in one of its plants. The capex incurred during the current year is rupees 149 crores, which mainly includes capitalization of new electronic facility at Bawal and Sanat plant expansion. This is all from my side. We will now open the call for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Ashutosh Tiwari with Equirus Securities. Please go ahead.
Yeah, hi. Congrats on a very good set of numbers this quarter. Firstly, how should we look at margins? Because we had also higher mold sales. So, do we make better than company margin on mold sales, or this is just cost that comes through basically?
So this is Anmol Jain, so I'll take that question. So we do make margins on tooling. However, it depends case to case. There is no standard answer that whether we make higher margins on molds than the operations. But overall, I would say we will definitely make better margins on the tooling in general vis-a-vis the operations. So that's on the tooling.
Okay. So you make better margin on tooling than operations. Okay. The second thing is that we had talked about that in the last Concall that with this new electronics plant coming into operation, there will be 1-2.5% margin improvement over a period of time. So have we got any benefit if we quantify roughly also, like what benefit we got from that backward integration in the last quarter?
So if you look at 2019-20, when the insourcing of electronics happened, at that point of time, the EBITDA margins did go up by almost about 1% or so. And I think obviously in the last fiscal 21-22, there were certain other challenges which, which also increased the cost structure. But I would say that it's very difficult to quantify exactly how much in Q4 would be the benefit. But for the full year, I would say that yes, it should be approximately the same as about 1% incremental because of the insourcing of electronics. I don't necessarily see the additional margins being expanded because of the Powell electronic facility per se, because the insourcing did happen in 2019-20. But going forward, as we scale up the Powell facility, we will get better economies of scale.
Okay. And have we got the full pass-through from the OEMs in the last quarter, or there's still something remaining and probably impacting margins still on the gross margin side?
Raw material consumption?
Yeah. So have we got the full pass-through of all the RM escalation, or something is still remaining?
Raw materials is an ongoing discussion and dialogue with most of the OEMs. I would say that majority of the raw material escalations have been received by the company. However, there is usually a time lag of about 3 months with certain OEMs, and whatever the spillovers are, we would expect to close them in Q1. Now that raw material prices have anyways softened and started to cool down.
So in general, how do you see the margins going ahead over next 1 to 3 year perspective?
So I've always maintained that, our first endeavor was to maintain a double-digit margin. And I think, we had the highest margin in 2019-20, where we crossed the double-digit threshold. Post that, of course, the last 2 years, because of certain challenges of COVID, cost structures, as well as the industry growth, the margins did fall back into single digits of sub 9% at EBITDA levels. But I would say that in the coming year, we would be able to plow back to double-digit margins. And going forward over a 3-year period, I think our endeavor is to reach the teen margins, get to a close to a 13% margin at a EBITDA level. That would be our guidance for the next 3 years or so. But at least for the coming year, we would be able to at least sustain into the double-digit territory, which has been, reported in the last quarter as well.
And lastly, we had talked about HVAC panel order, which will probably begin in FY24. Is it 24 only, or this is start before that? This was for the Toyota Maruti model, right?
Hi, this is Vineet Sahani. The HVAC panel is for Honda, and we are starting in, as per the plan, FY24, and this will be the first product. And there is a plan to it, and we are following the same plan. There is no change.
This is Honda, you said?
That's correct. It was Honda 4-wheeler. It was not Toyota.
Yeah.
Okay. And just one more question. When we highlight order book of 800 crores, what does that exactly this means? I mean, this order book means over what period of, over what months or quarter, what exactly you mean by this order book?
So when we talk about the order book, this is Anmol Jain again, there is usually a development lead time between 18 to 24 months for the launch, and thereafter there is some lead time for reaching the peak volumes. So the 800 crores order book is probably going to get peaked out in the next 2 to 3 years. However, I would say that the good part to look at is that only about 20% of this order book is replacement order, and almost 80% of the 800 crore business is actually new orders. That means the company has either got new platforms or got new products of certain platforms where the company was not present today. So that is a healthy sign. But answering to your question, the peak of this 800 crores would probably come after 2 to 3 years.
This is the peak order revenue potential from the new order that you have won basically in the recent past.
This is based on RFQ orders.
That's okay. That I understand. But this is like say, will this in this order book does it mean that you probably are gaining market share, or how should is it X of Maruti a bigger order winning a good order book as well?
Absolutely, we will be gaining market share. I would not be able to divulge details in terms of which OEM we will be gaining market share in and vis-a-vis which competition. But as I said, these are new orders, almost 80% of them, which the company does not have today. So clearly we have increased the wallet share in certain OEMs, and we've been able to get orders of certain new platforms which the OEMs are launching.
Okay, thank you. Thanks a lot.
Thank you.
Thank you. Our next question is from the line of Abhishek Jain with Dolat Capital. Please go ahead.
Thanks for opportunity and congrats for strong set of numbers. Sir, is there any one-off benefit in quarter 4 in EBITDA level like previous quarters under recovery that was accounted in this quarter?
There is one-off cases in FY22, except that if you're looking at the EBITDA margin, there is a very high mold sales and has a strong margin on the mold sales in quarter 4 specifically. So going forward, I would say that would kind of even out, but that is the only one-off case because mold sales are not every quarter. They are dependent on the launch of the OEM.
So next year we are expecting a lot of the new launches will come from the different OEMs. So mold sales, how is the outlook for the mold sales for the next financial year?
I think on an annualized basis, the mold sales will be approximately 100 to 150 crores, which is pretty much similar to what the company does on an annual basis. I don't expect any significant increase or drop in that, but I was more referring to your question pertaining to the last quarter, where you asked me if there is any one-off cases. I was just trying to make you understand that there was a high tooling sale in quarter 4 itself, which would obviously not be recurring in each quarter.
Okay.
Also, just to add, I think, so there is no exceptional addition on profit. There is an exceptional expense, which is about 6.79 crores during the quarter for the BSS scheme, which we had launched on.
Okay, sir. So during this quarter, material expenses to sales ratio has again gone up. So what would be the key driver for the gross margin expansion going ahead?
As I mentioned earlier, the guidance for the margins going ahead would be to sustain the double-digit EBITDA. An EBITDA in 2019-20 was close to about 10.5%, and we would definitely like to sustain that EBITDA going forward during the financial year. And given a 3-year outlook guidance, our endeavor is to expand the margins to get closer to the teen EBITDA levels, close to 13%.
Okay, sir. And sir, how much is your current import content, and what would be the import content after the commissioning of this Bawal plant? Will it reduce?
So the import content in terms of the LED lamp is approximately still, I would say, 50 to 60% on the headlamp and about 30% on the tail lamp. This is primarily for the LED lamps, and with the localization, I would say that probably about half of it should be able to get localized over the next couple of years.
Okay, sir. Sir, my next question is related with the capacity additions. So you have done a capacity addition in for the Gujarat plant. So what would be the incremental revenue from this?
So the incremental revenue of Gujarat plant would come into play in FY23. Approximately, we are expecting about 200 crores incremental revenue from the Gujarat facility because of the investments made in last year.
Okay. And if I talk about the total capacity and capacity utilization, what is the capacity utilization as per the Q4 numbers?
I would say in general, the capacity utilization would be close to about 80%. Certain plants, it could be as even low as 70%, but I don't see any plant which is operating less than 70%. But 80% would be a good ballpark to go with in terms of the utilization of capacities as on Q4.
Okay. So, sir, next year, most of the OEMs are guiding around 15 to 18% growth on the passenger vehicle side. So, are you looking for some capex to increase your capacity to meet the demand?
So we will be incurring some nominal capex in FY23 as well. It would be definitely much lower than what we had incurred in FY22, because in FY22 there were certain expansions in the Gujarat facility. So in FY23 there would be some capex, nothing on a greenfield expansion, but yes, there would be certain brownfield expansions and enhancements across the plants.
So just if I want to also come in here, so let me put it for the outlook for this financial year. I think that would be relevant in this question. The industry probably we're expecting to grow somewhere between 10 to 15% for this financial year. For the current existing, let's say, whatever revenues you've clocked, hence, since we are doing all across the segments, so we should anyways get a 10 to 15% increment on the revenue. However, because of certain new order launches and the investments what we have done in Sanand, they basically will start looking at, as what Anmol said, as an incremental revenue of additional 200 to 250 crores. With that, I think we would be clocking probably double of what industry average would look at. So hence, we're expecting a strong financial year in the coming year.
So we can expect around 18 to 20% growth in the passenger vehicle lighting side.
So we are expecting maybe more than that as well for this financial year. Our outlook would probably be an EBITDA of a double digit and probably a revenue growth of somewhere, probably as you say, 18 to 20%. I probably would say 25 to 20%.
And the CV growth was quite strong, around 48% in the last year, and this year also it is expected to be very strong. So what is the outlook of for the fight?
So I'm giving you all segments outlook factored in within our revenue book, right? Because I mean, if I talk, so I'm talking about the revenue what we have done in this last financial year to this financial year.
Let me just clarify that, Abhishek. The revenue forecast for next year is probably going to be a shade better than the revenue growth we have clocked in FY22.
Okay.
Now, that comprises of all segments and our wallet shares with each OEM. Now, we cannot forecast how much the passenger car is likely to grow and how much the two-wheeler is likely to grow. There are a lot of volatility and challenges which still lie ahead. But despite, based on our discussions and our schedules received and production plans received, we will be able to do a shade better than FY22 growth rate as a company.
Okay, sir. My last question is related with this SL Lumax. So what is the outlook there, and can you please provide us the revenue return PAT of SL Lumax?
I think SL Lumax remains to be one single entity, customer directed entity. And as you see, I mean, say we are expecting what the revenues of that Korean customer comes in terms of the growth. We will probably see a similar kind of revenue growth with SL Lumax as well.
And what is the number for the revenue, EBITDA and PAT for FY22, sir?
We haven't disclosed that yet. I mean, so again, we would probably be talking about a double-digit growth.
It clocked double-digit EBITDA in FY22.
I'm talking about the revenue growth.
Okay. Thank you, sir. That's all from my side.
Thank you. Ladies and gentlemen, if you would like to ask a question, please press star 1 on your telephone keypad. Our next question is from the line of Sanjay Shah with KSA Securities. Please go ahead.
Yeah, good afternoon, gentlemen. Thanks for opportunity. So appreciating your performance in these challenging circumstances. Deepak, sir, my question was regarding our growth trajectory where we are moving. So can you highlight upon the rationale? How do you see these challenges on chip side, logistic issues, supply chain? When do you see this automobile industry coming out of all these woes? And when you see this normal growth trajectory comes back to our domestic market?
Good afternoon, Sanjay bhai. Thank you for the question. I think, these challenges of chips, shortages, conflict, commodity prices, I'm factoring all this already in. What I've not factored in is what is another surprise which comes out. But I think if you look at it, I think the industry, as I mentioned in my opening remarks, is poised for a very, very good growth and a bounce back. There will remain challenges, and I tell you the challenges what they are. The challenges would be probably the inflation, probably would be the interest costs, could also be certain demand side escalations based on which there could be supply side constraints. So these will remain out. I think what we have to focus upon is the industry is looking at a double-digit growth. And as an ancillary, our focus would be to beat the industry growth. And hence, we, as Anmol also said, whatever last year performance had been on revenue, and last year we have to see that the quarter one was pretty much muted. We will probably see again that in this next 12 months, with new launch products, with basically already investments in place, we should be able to ramp up better, much better than what the industry growth average is. And if we're able to do that, we would also be able to offset some of our more fixed costs and basically have incremental, I would say, margin expansion as well to come back to a good double-digit system. So that's, I think, what our outlook is for this financial year.
Right. Sir, as we have been learning about the industry, especially Maruti is coming out with a great capex announcement of a new project. Plus, we are even looking at our portion of LED may go up from here on, which we have been desiring. And the new AFS functionality and matrix headlight and all. So do you think that we, at a stage now, we have to start think of expanding or having a new strategy of growth from 2 years from, after 2 years from now, or maybe 3 years from now?
So long-term strategy remains similar. I think we had already made an investment commitment for electronic facility, which is auguring well with the localization plans as well as localization competency. Whatever, the new technology lamps you talked about, ADB, AFB, I think the fundamental thing is they have more LED input in it. There is more electronics in any of the new lighting technology. I must also say that we have opened up our Czech office, which is a European office, and we are also, and the main reason is we are expanding the competence and capacity of our engineering strength. So I think there will be a lot of new RFQs coming in, more complex RFQs coming in into the company. And to handle that, I think we are now building up the capacity and the competence on the engineering capability. About 5 years ago or 6 years ago, we had basically opened the Taiwan Design Center, and that was mainly for the project management on the imports of tooling. I think that has augured well. We have been able to come, and the next step we have already taken is to expand in basically the European Design Center. So I think these two strategies remain, and localization strategy on competence and capacity on electronics will remain in the company so that we are able to maximize the potential RFQs which comes through.
Yeah, so Vineet this side, just to add on, I think all the related competencies that are required for new technology that you mentioned, for example, ADB, Matrix, that is today in-house in our European office, as just explained. So the company has been proactive in creating these resources to address the changing need of the technology in the market condition.
Yes, sir. Very helpful, sir. Thank you very much for explaining. And good luck to you, sir.
Thank you.
Thank you. Ladies and gentlemen, if you would like to ask a question, please press star 1 on your telephone keypad. Our next question is from the line of Ankit Agarwal, an investor. Please go ahead.
Thanks for the opportunity. Maybe this has been covered in earlier calls, and I recently started covering the company. So, sir, for the lighting division, how do you decide what part of the business goes to Lumax Auto Technologies versus to Lumax Industries? Because there seems to be a 30-40% contribution of lighting even in that business. So are there certain customers which are demarcated, or is it basic orders and capabilities?
So I'll answer that. I think this has question come in, and we have been already clarifying. I think Lumax Industries, this company does all basically the OEM lighting business, except for one account, which is Bajaj Auto. Bajaj Auto account is catered by the other group company, which is Lumax Auto Technologies. And the aftermarket of lighting is serviced by Lumax Auto Technologies. Lumax Industries does not directly do lighting into the aftermarket. However, it does support Lumax Auto Technologies on certain of the aftermarket product lines where we do not have any conflict with our OEM customers. And this will continue to go on as is. Other than that, all lighting products, lighting customers, lighting opportunities are captured in Lumax Industries.
Makes sense. And for this, in Lumax Auto Technologies, you have added and expanded quite a few lines over the last several years, and that company has done very well. So is there a plan to add more lines within Lumax Industries? Or I know you mentioned the
Lumax Industries remains as a single product line with our single partner, which is Stanley Electric. As we had just mentioned in the call, there is a product line called HVAC panel systems that is produced by Stanley. We will be doing that in FY24 going forward, and some electronic components which Stanley does. So Lumax Industries remains as a major lighting product manufacturer with alliance with Stanley promoted equity as well.
Makes sense. And on the lighting side, sir, how much market share would we have in the OEM lighting industry? I know we are the market leader, but how much market share would we have, and who would be the key competitors, and what would be their market share?
So first, basically, Lumax Industries also has an associated company, which is SL Lumax, which caters to the Koreans. Lumax Industries caters to all other segments and the non-Koreans, which are basically the Kia and the Hyundai is done with that. If I accumulate that lighting business, then we almost have about close to 65 to 70% market share within the country.
If you include the Korean businesses, then you have almost.
Then it would come to around about. Then it would come about 50%.
So 50% without the Koreans and 65-70 with the Koreans.
Yeah, because if you see the market structure, I mean, say almost 45% is Maruti Suzuki, and the balance basically 20% is Koreans, 10% Tata, and we actually cater to almost all segments. Of course, I mean, so not 100% on all the other customers.
Understand. But within these accounts also, you will have a disproportionate wallet share. So all the lighting purchased by OEMs in the country, you are saying if $100 of lighting is bought by OEMs in the country, $70 is sold by Lumax through all its group and so on.
With SL Lumax included. Absolutely.
Understand. And one last question, sir. You mentioned that for the coming year, industry forecast of growth is about 10-15%, and you feel you can grow at about 20-25%. Are there specific drivers for the market share gain, given you are already at a pretty high market share?
Yeah, as I said, I mean, so there is, again, 2 platforms which we have got, 2 new customers. Not new customers, but 2 customers will actually drive that growth. The company had already invested in our facility in Sanand, and those two customers will drive the additional growth apart from the nominal 10 to 15% growth, which anyways we will be getting as per the industry growth. So because of that, we're expecting a 25 to 30% growth.
Got it. And from the current capacity that we have, what would be our revenue potential at full utilization, and how is 100% utilization possible in this industry, and what sort of revenue can you attain with the current capacity that exists?
Well, in this, go ahead, Amar.
So I can't give you an exact number like that because it's more complicated than that. If you're talking about capacity utilization in terms of numbers, then it hugely differs from a two-wheeler lighting to a four-wheeler lighting, and there are certain plants which cater to both. Also, based on the technology levels in each lamp, the revenue per lamp or the revenue per vehicle can be hugely different to the tune of 2x or 3x, LED versus non-LED, etc. So it's very difficult for me to give you a number of revenue in terms of that's what we can do in terms of full capacity utilization. But I think, as I mentioned earlier, 80% is probably the ballpark capacity utilization as of end of quarter 4. And you would probably, you can see the revenue of quarter 4 as a, standalone quarter. And if you were to prorata it for an annualized basis, I would say give or take, that would be the broadly number which we should be able to attain with some improvements to a 90% capacity utilization. As a thumb rule, we always start putting investments towards capacity expansion the minute we reach a threshold of about 85%. Because the 10 to 15% capacity we always keep as a buffer for spare parts or other urgent or one-off requirements.
Understand. So what you're saying is 550 crores was the revenue in Q4, and that was at 80% utilization. So broadly 2,200 crores if I annualize it and adjust for 80%, about 2,600 crores ballpark can be done with the current capacity.
No, that is not what I'm saying. Please take out the toolings from 550. Tooling has nothing to do with my capacity utilization. 488 crores is my manufacturing revenue in quarter 4. And if you were to prorata that, it would broadly be less than 2,000 crores, give or take 1,900 something crores, which is what I am saying that at a 80-85% capacity utilization, that should be my revenue. So if I'm looking at a 20-25% incremental growth next year, obviously if we do the math, it should be crossing 2,000, 2,100 crores. And for that, there would be some brownfield, minimal expansions or capacity enhancements or capex, which will go in FY23.
Understand. Got it. And one last question, if I may. How do you think about volume growth versus value growth? Because obviously the volumes are in India for passenger vehicles are almost 20% below FY19 levels, but still the company's revenues are not at FY19 levels, but only 10% lower. So is there a lot of inflation happening in lighting, and what's the right thumb rule that one can take for inflation for the coming year and for the years after?
So answering to that question, I think, someone mentioned that the pass car is expected to grow at about 10 to, let's say, give or take 15% in the coming year. And these are all volume numbers. The two-wheeler is probably going to grow in single digit as far as the industry goes. So cumulatively, then the industry will probably be just little less than 10%. That's the forecast which we are getting on a FY23. But if I am growing as a company in my revenue at, let's say, 20 to 25%, then clearly the delta difference is not just coming out of volume, but also a significant part is coming out of the technology and the realization per vehicle or per lamp. So I would say that give or take 50 to 60% of the growth would be driven by volumes, and about close to maybe 30-40% would be driven by the technology shift.
So you think after 25 to 30%, let's say about 12 to 15% is volume, and the balance 10-12% is coming from realization per lamp or realization per vehicle.
Yes.
Understand. And has that been the trend historically as well, about 10-odd% realizations going up year on year?
I would say it would be probably lesser. Technology would be lesser. It would be more volume driven. I would say that, but this year, because of certain technological shifts and winning certain new platforms which are on the higher technology, the contribution of technology would be a shade better than the previous year.
Understood. Got it. Thank you so much for addressing those questions. Very helpful.
Thank you.
Thank you. Ladies and gentlemen, if you would like to ask a question, please press star and the 1 on your telephone keypad. Our next question is from the line of Sunil Kothari with Unique Investments. Please go ahead.
Thanks for the opportunity, sir, and congratulations for really good numbers during at least last quarter. And this year also was very challenging, but we have done really well. So my question is, just listening to the reply to our revenue capability, which we absolutely are saying maybe around 2,000 or 2,100 or something like that. During 17-18, I think our LED year 17-19 financial year, LED contribution was roughly 15-18%. Now it is 33, which you likely say always that LED pricing is always 2x or 3x. We have invested almost 600 crore during last 5 years, combined capex. And we were doing roughly 1650 during that time, now 1750 revenue. So this incremental investment will not add any substantial revenue capability with 2x, 3x pricing of LED. I'm little bit not able to understand this investment's outcome. If you can please explain.
Yeah, so I'll just take that question. Number one, if you look at our highest revenue, it was in 18-19 at about 1,850 crores.
Yeah.
If you look at 17-18, 18-19, the LED penetration was about 25% and about 75% was non-LED, which today has gone up by about close to, give or take, 30% and come to 33% of LED. So LED organically has grown up by almost 30% compared to that base. The investment over the last, give or take, 4 years has been close to approximately 400 odd crores, which the organization has done. And as I said, a bulk of this investment also went into the electronics, which did not add the revenue. Please understand that. So a significant portion of the 400 crores went into the electronics plant, which was adding to the margins, but it did not add anything to the revenue. So if I take that piece out, you are looking at a better sales to gross block ratio. My sales to gross block ratio is about 1:1.5. And if you take out the electronic investment out of the 400 odd crores, you are looking at almost close to about 1.8 or so in terms of the sales to gross block. So my request would be to, if you are taking out the electronic plant investment and then seeing the gross block expansion vis-a-vis the revenue expansion, you'll probably see that we've done a better sales gross block ratio than the previous years.
Also to add on, beneath this side, certain investments done in the past would fructify in this year, as already explained, especially for the 2 models for 2 major customers, where the start of production has happened now in this month. The investments have been made in the previous financial years.
Right. Okay. Sir, do we have any objective to achieve respectable ROC, which we were achieving during 17-18, 18-19, around 30-32%? Maybe during next 2-3 years, can we cross those numbers, or you do not like to comment on that?
No, so the ROS level as a group, as a strategy, usually we are targeting a 25% ROS, give or take. Yes, we did have a 30-32% ROS in 2017-18 or 18-19, but our endeavor would be to get to a 25% plus ROS, and I'm hopeful that in the current year we should be able to attain that.
Great, sir. And sir, my last question is to Deepakji. Sir, our organization enterprise value with equity around 1,000 crore and 300 crore debt combined is 1,300 crore. How do you look at this valuation, which is given by equity investors? what's your thought process? I understand you should not comment on the stock prices, but are you happy, okay, or you feel there is some pricing of our equity valuation, looking at our capability or revenue capability, the way we are talking about improving margin? Would you like to comment, or do you have any internal effort to improve this type of mispricing of our organization?
Well, I think I rely on friends like you to have some offline chats about that. However,
Sure.
I think our fundamentals are driven not by stock market, but our fundamentals are always driven by customer. We strongly believe that as long as we are servicing customer needs and providing value to them, we will have good revenue and profitability outcome, which would eventually reflect in value creation for all our shareholders.
Sure, sir. I will be happy.
That is the policies.
Sure. I'll be happy to give some feedback offline with maybe Sanjay Bhai or you. Thanks a lot.
Sure. Thank you.
Thanks a lot. Good luck.
Thank you. Our next question is from the line of Riya Verma with Oracle Securities. Please go ahead.
Hi, sir. Thank you for this opportunity. So firstly, I wanted to ask, what is the proportion of order book from EV in our total order book of rupees 800 crores?
It would be about close to 40% or so.
Okay. And sir, if you could throw some light on our product portfolio from our new facility at Bawal, and is there any anchor customers for it, or will we be cross-selling among our existing customers and increasing our wallet share?
So when you're talking about Bawal, are you talking about the electronics facility?
Yeah.
So the electronics facility is actually more like a backward integration to the lighting. The customers of the end customers for the electronics facility are largely dependent on the order book of the lighting. So whichever orders we are servicing on the lighting aspect are the same customers and the same models whose electronic parts will be manufactured in the Bawal electronics facility. So there is no B2B to the OEM from that facility. It is more of an internal facility as a backward integration strategy.
Okay. Yeah, so that answers my question. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for the day. I would now like to hand the conference over to Mr. Deepak Jain for closing comments.
Well, I would like to thank everyone for joining on the call and would like to say that we remain confident on the growing prospects of India and the automotive sector. I hope that we've been able to respond to all your queries adequately, and for any further information, I request you kindly get in touch with SGA, Investor Relations Advisors. Thank you very much and have a good afternoon.
Thank you. On behalf of Lumax Industries Limited, that concludes the conference call. Thank you for joining us, and you may now disconnect your lines.